available on the Chamber website. And I do believe, Andrew, you said you guys will be sharing this on the Sciarabba Walker website as well, correct?
That's right.
Awesome. All right, well, got about 2 more minutes here. Give people time to get their refreshments and snacks prepared, and a few more minutes for people to get registered and get in, and then we'll start promptly at 12:05. Thank you again for being here with us today. I think this is actually webinar number 10 in our webinar series, our Learn series. So glad you could join us today. All right, I'm gonna go ahead and get us started here. I will continue to add people as we go on, Andrew and Michelle, so I'll take care of that. Good afternoon. My name is David Walton, the Event and Program Manager for the Tompkins Chamber, and it is with great honor to welcome you to another webinar in our Business Readiness series focusing on COVID-19. Today's webinar is on COVID-19 tax considerations and available assistance, hosted by 2 amazing people from Sciarabba Walker. Sciarabba Walker is a member of the Chamber, and joining us today are Mr. Andrew Hart. Andrew is the Marketing Director at Sciarabba Walker, and Ms. Michelle Flinn. Michelle is a CPA and Supervisor at Sciarabba Walker. So our Learn series is brought to us by our sponsor, Tompkins Trust Company. So we thank them for making this series available for you during this tumultuous time of this pandemic that we all face together. But without further ado, I'm just going to turn things over to Andrew, and he'll kind of set us up for what it is we hope to accomplish today in our webinar.
Thanks, David. Thanks to everyone for joining today. As David said, my name is Andrew Hart. I'm the Marketing Director at Sciarabba Walker. Really, we wanted to take some time today to share kind of what we've learned over the last month or so since the CARES Act has been passed. So the CARES Act is the Coronavirus Aid, Relief, and Economic Security Act. It was passed on March 27th, and it brought about a bunch of many different programs that were geared to providing relief to businesses and individuals in the wake of this pandemic. So as soon as that bill was passed, we knew that this was going to have a wide range of impacts on our clients and the community at large. And Sciarabba Walker established a CARES resource team of a couple of individuals within the firm. Michelle has really been the point person of that group, staying on top of the ins and outs of the different programs that have been created, and sort of the effects that they can have in different ways. So Michelle is going to be leading us through, as I said, kind of what we've taken from the past month or so here, and then look a little bit ahead to the future as well. I will quickly turn this over to Michelle. One thing I want to do as the marketing guy, I'd be remiss if I didn't plug the resources that we've put together on our website. Again, Michelle has been a huge part of this. I dropped a link into the chat here, which will take you to our breakdown of the CARES Act. Within that blog, there are links that take you to individual kind of topic-based blogs, a little bit more specific. So that can be a good place to start. But with that, I will turn everything over to Michelle here and let her run the show.
Hey, really quick, Michelle, before you get started, one thing I forgot to add, thank you for reminding me, Andrew. If at any point you guys have any questions for either Andrew or Michelle, please feel free to use the chat box function to type out any questions that you may have. And we do have time for Q&A at the end, but Andrew will also be pulling some of those questions and queuing them up for Michelle in the midst of her presentation today. All right, take it away, Michelle.
Sounds great, thank you. So as I said, I am Michelle Flinn. I'm a supervisor and CPA at Sciarabba Walker. I've been there for almost 7 years now. And I am primarily in the tax department. I have done audit and outsourcing, but my primary focus now is the tax side of things. So I quickly will run through the agenda on what we'll cover today. So the first thing we're going to look at is what the new due dates are for tax returns and tax payments. For federal, and we'll cover New York State quickly. Then we'll look at a brief overview of the Paycheck Protection Program and Economic Injury Disaster Loan programs. Essentially, there's been a lot of information already out there on these programs, so we'll do a brief sort of basic overview and then go over any changes or any new information that came about with the recently passed bill on Friday. Then we'll take a look at the employee retention credit and the payroll tax deferral that are available, as well as the changes to net operating losses and carrybacks. Then we'll take a quick peek at the technical correction for qualified improvement property. And then we'll take a quick look at the individual provisions and have the question and answer section. So recently, the legislation that passed due to COVID-19, there were 3 main bills that we essentially have been looking at and going over. The first one would be the Families First Coronavirus Relief Act, or the FFCRA. And that was signed into law on 3/18/2020. Then there was the Coronavirus Aid Relief and Economic Securities Act, or the CARES Act, which was signed on March 27th. And then lastly, the Paycheck Protection Program and Healthcare Enhancement Act, which was signed on Friday, April 24th. So the first big change for a lot of our taxpayers in this area is that the individual, fiduciary, and C corporation returns that were originally due April 15th are now automatically extended to July 15th, and there's nothing anyone needs to do to get that extension. It's automatic. And that's both to file your tax return as well as pay taxes. And that is also true for New York State. I would recommend, if you file in any other states, that you either check the state website or contact your tax professional. Most states, especially for individuals, extended the filing date and payment date, but there are a handful of states for individuals and a few more than that for corporations that have either weird extension dates or have nuances that are specific to their state. At the time that COVID-19 really hit our country was around the time of the partnership and S Corp deadline of March 15th. Due to those being around the same time, there was no relief for those types of entities. So those due dates were March 15th, and extensions for those companies who couldn't file and pay were done, and they have an extension until September 15th. In the beginning of April, the IRS came out with Notice 2020-23, which really expanded the list of returns and types of taxpayers that were going to get relief. This notice opened it up for returns due between April 1st, 2020 and July 15th, 2020 to get an automatic extension until July 15th. This includes fiscal year partnerships and S corporations, so any non-calendar year end entity of those types that did not, or that fall into a due date of between April 1st and July 15th will get that automatic extension. It also extended the 990 series returns, so 990EZ, 990s, 990Ts, the associated estimated payments with those, and the estate and gift tax returns were also extended. There's a very long list. I recommend if you have questions on if a return or form is extended, that you reference the notice, and it's very easy. The IRS website has been very relatively easy to search and look through the information they're putting out. So this is the FAQ that I'm referencing. They recently updated it. I believe it was April 23rd or 24th, so the end of last week, to account for that new notice that extended all those other types of returns. For federal estimated payments for first and second quarter, which are normally due on 4/15 and then 6/15, both of those have been extended to July 15th. For New York State, they have extended the first quarter estimate from April 15th to July 15th, but the second quarter estimated payment is still due June 15th. And they may come out with guidance that will extend that, but New York State at this time has been relatively silent on that. The Paycheck Protection Program. So the second round of applications started on Monday at 10:30 a.m. The second round was made available by the bill that was passed on Friday. It gave another $310 billion, I believe, to the program, with $60 billion earmarked for specifically for small lenders, for small businesses and businesses that may not have banking relationships. The applications are done through local lenders and who have been approved by the Small Business Administration. The PPP loan has a forgivable component. If you have any amount that is not forgivable, it is a loan for, it's a 2-year repayment period. The payments are deferred for 6 months, and the interest rate on that would be 1%. So it's a relatively low interest loan for any amount that is not forgivable. They recently came out with guidance earlier this week that specifically states that the loan funds must be distributed 10 days after the loan approval by the SBA. There were some organizations who were trying to push their 8-week starting period. So this guidance sort of stops that from happening and gets the funds to the small businesses that need it as quickly as they can. Once you receive that funding, the 8-week period to spend the money, and that is used for the loan forgiveness calculation, starts the day you get those funds. What can the loan be used for? So employee payroll costs, they've come out with a lot of interim guidance, and they have some really good FAQs on the SBA website, as well as the Treasury website, that really go into depth on this and help sort of figure out what costs are allowable. Owner compensation replacement, so that's calculated on your 2019 net profit. This is for sole proprietorships who file Schedule Cs. They were allowed to apply for the PPP loan, and they have different loan calculations and different forgiveness calculations, but this would be one of those expenses that they can take. It would be mortgage interest payments on any business mortgage obligation or personal property that was in place prior to February 15th, business rent payments, and business utility payments. On Friday, the SBA came out with about, I think it's an 8 or 9 page document on guidance for how to calculate the maximum loan amount based on the business type. So it breaks it down versus if you're a sole proprietorship, if you're an S Corp, if you're a partnership. It really breaks down how do you calculate the maximum loan amount, where to pick up the information, using prior year tax returns, and is a really useful document, and that can be found at the Treasury website. And the link I pulled is actually from the SBA, so the SBA will link you to the Treasury. Restrictions on the use of PPP loan proceeds. For forgiveness for the PPP loan, you have to use 75% of the loan proceeds for payroll-related costs. This will be really important. If you fall below that, there's a potential that you will not receive any forgiveness. So what amounts will be eligible for forgiveness? The payroll costs will be eligible. It's for an 8-week period per individual. There will not be, the maximum you can get forgiven is $15,385. And that's due to the fact that you cannot exceed $100,000 of compensation for an employee or partner owner or S Corp owner. So the $100,000 being capped, that is the $15,385 per individual, and that would be what you can get over that 8-week period. You can then take the healthcare expenses and retirement contributions and state taxes imposed on employee payroll for the employees on top of that amount. Then if you are a sole proprietor, for the payroll calculation, you would take 8/52 of the 2019 net profit to calculate what your payroll portion that could be forgivable is. So that payroll piece would need to make up 75% of the loan proceeds. And then for the other 25%, that can include interest on mortgage obligations or real or personal property incurred before February 15th. And it's important to note it's the interest, not the principal. Rent payments on lease agreements in place prior to February 15th, and utility payments with agreements dated prior to February 15th. There's a lot of questions and unanswered questions related to the guidance for the loan forgiveness and how the forgiveness is going to be calculated and what that will look like. How do you apply for loan forgiveness? We're still waiting on the SBA to issue this guidance. We're hoping to get it within the next couple weeks, but for a lot of people that could mean right at the end of their 8 weeks. So if they're trying to be very cautious about what they're spending it on, it could create a little bit of a problem. So stay tuned. We'll get guidance out as soon as we possibly can once the SBA releases it. The next type of assistance from the SBA that is out there is the Economic Injury Disaster Loan. And this is a 2-part process. So the first application you fill out is done right through the SBA, and it's right on their website. And the first application is for what they call an emergency advance. And that amount can be up to $10,000. And we'll go into that in just a minute. Once the process is completed for the advance grant, an SBA loan officer will reach out to the applicant and actually help them complete the application for the EIDL loan. So they both fall under that EIDL umbrella, but it is 2 separate pieces that one piece needs to be done before you can move on to the other. The SBA are not accepting new applications for the EIDL loan at this point in time. They received additional funding under the bill passed last Friday, but they had so many applications still left in their queue. They are going to first go through that queue on a first come, first served basis and complete those applications. If there's any money left over at that point, they'll reopen the application process on their website. The emergency advance, like I mentioned, it's up to a $10,000 essentially advance grant is what they like to call it. And the calculation for that is if you're a sole proprietor, it's a flat $1,000. For every employee you have on top of that, or for as many employees as you have, it's $1,000 for each employee up to that $10,000. The advantage with this item is that it's supposed to be a very quick turnaround. We have not seen that yet. What's supposed to happen is once your application is successfully completed, you are supposed to get the up to $10,000 within a few days. What tends to happen is that lacks a little bit because when the program first came out, it made it seem like once you apply, it'd be a few days. The application process takes a couple weeks, so then it's not as quick flowing of money as we expected. So then once you do the application for the EIDL loan and you do the advance portion, then someone contacts you, you do the actual application for the EIDL. And you can use these funds for providing sick leave, maintaining payroll, increasing material costs, making rent payments. It's essentially, you can use it for working capital. And that's how the loan is actually calculated. It's based on 2 months of working capital. And the loan was limited to $15,000, not including your advance. And that is the guidance that we had before. We're believing that that's still going to stay in place due to the number of applications that are out there. This loan does not have a forgiveness piece. So the advance grant can be non-taxable even if you're denied for the EIDL loan. But the actual EIDL loan is a loan that has a repayment of up to 30 years and an interest rate of 3.75%. They had originally projected about 2 to 3 months to see the funds. Due to the backlog, we have a feeling it may be a little bit longer than that. The employee retention credit, sorry, I just wanted to note, on the PPP loan forgiveness, if you get an advance from the EIDL, that amount of the advance is not forgivable as part of your PPP loan. This has been an area of a lot of confusion. So this is how it is currently stated as being laid out. But again, we're really waiting for that guidance to see if that's the case, because the advance was supposed to be a non-taxable event. So we're waiting to see what the guidance comes out with, but that is a little caveat that as it currently stands, the advance that you receive from the EIDL has to come off of the amount that can be forgiven under the PPP. Also, if you use the EIDL loan for payroll, the EIDL loan has to be rolled into your Paycheck Protection Program loan, which means a low interest rate of 1%, but it has to be paid back within 2 years. So if you use your EIDL for other expenses other than the payroll, it'll be a little bit more advantageous with a longer pay off time. The employee retention credit. So employers who fall under 2 categories for this credit can take this credit. So it's an either or situation. So if an employer was part of a government order related to the COVID-19 pandemic that required the business to partially or fully suspend operations, which if you're a business operating in New York and we're not an essential business or had a mix of essential and non-essential businesses, the orders that were issued between March 14th and March 20th put you into this category to be eligible for this credit. The other way to be eligible for this credit is if you experience a reduction of greater than 50% of quarterly receipts as measured by a year-over-year basis. So an example of that would be if you look at Q2 receipts from 2020 and Q2 receipts from 2019, if your Q2 2020 receipts are 50% less than your Q2 2019 receipts, you qualify for this credit. If you qualify for this credit under the gross receipts reduction, your eligibility ends with the calendar quarter following the quarter in which your gross receipts exceed 80% of the corresponding calendar quarter of the prior year. So again, if we're looking at Q2 2020, if you hit that 80% of what Q2 2019 receipts are, the next quarter, Q3, you would not be eligible for the credit. Eligible employees. So if you have less than 100 full-time employees, all employees' wages are eligible regardless of whether or not that employee was furloughed or not. If you have more than 100 full-time employees, the only wages you can take into considerations are those who were furloughed or faced a reduction of hours as a result of the closure. And the purpose of determining, for the purpose of determining the number of full-time employees, you would use the average from 2019. Calculating the credit. So the credit is actually 50% of eligible employees' wages from March 12th, 2020 to January 1st, 2021. So essentially December 31st, 2020. The amount of wages and related health insurance benefits that can be taken are capped to $10,000 an employee, which means you would be eligible for a maximum credit of $5,000 per employee. One caveat is that if you take any of the paid leave credits under the FFCRA, you can't use the same wages to take the employee retention credit. So essentially they want to try to stop double dipping. So you'd have to use separate wages for this calculation. How to claim the credit. So the credit will actually be claimed on a quarterly 941. Now, because the date starts on March 12th, there's an overlap from March 12th to March 31st in the first quarter. The IRS has come out and said, do not report any of the employee retention credit for the first quarter, report it all on the second quarter. So first and second quarter for this credit will be reported on the second quarter 941 return. You can request an advance for the credit on Form 7200. This is a fully refundable credit. So what that means is you would calculate the applicable payroll taxes that this credit pertains to. You would essentially leave that as a credit for your 941 when you calculate your Form 7200, and then any amount over that calculation, you would be able to request a refund and you'd receive a check from the IRS. Who cannot claim the credit? So if you are taking part in the 7A Paycheck Protection Program, you are not eligible to take this credit. Also, federal, state, and local government employees are not eligible for the calculation. So any employer who has those types of employees would need to be careful with the credit. Next is the payroll tax deferral. So this allows businesses and self-employed persons to delay or defer the payment of employer portion of Social Security taxes for March 27th to December 31st. And how that works is you would not have to send that money for the employer portion of Social Security tax to the government. You would defer that, and what you would do is you'd look to see what your deferral was at December 31st, 2020. Half of that would be due the next year on December 31st, 2021, and the second half would be due by December 31st, 2022. The payroll tax deferral, employee retention credit, and the paid leave credits under FFCRA, they can all be taken together in conjunction, as long as you are not double dipping those wages for the employee retention credit and paid leave credits. The interesting interplay with the Paycheck Protection Program, so you can take the deferral of the Social Security taxes for the employer portion up until the point in time in which you are told by your loan provider your forgiveness calculation. So you can defer those taxes up until the point where they say, here's what we're approving for your forgiveness. At that point, you would not be eligible to defer any more Social Security taxes. And then you would still fall into the same applicable period as anyone else who did not take the PPP program. So you would take whatever your deferral was at that time, divide it by 2, half would be due December 31st, 2021. The other half would be due December 31st, 2022. Net operating losses. So this pertains to specifically to businesses. What is happening is they are now allowing, under the CARES Act, tax years 2018, 19, and 2020, for any of those 3 years that a loss arose, you can now carry that loss back to the 5 preceding tax years. So any NOL prior to 2018 still can only be carried back 2 years and carried forward 20 years. Any net operating loss that occurred in 2018 or 19 and may occur in 2020, that will allow you to carry it back 5 years and carry it forward indefinitely. Anything after 2020 tax year, there are no carryback provisions, but you can carry forward that NOL indefinitely. There's also a change under the CARES Act to the taxable income limitation. Prior to the CARES Act, the Tax Cuts and Jobs Act limited the NOL carry forwards for post-2017 tax years to 80% of taxable income. The CARES Act now says that an NOL in 18, 19, or 2020 can fully offset taxable income. So you can use 100% of your NOL to fully exhaust your taxable income. What that means going forward is that any NOL prior to 2018 is going to be able to be taken at the 100% of taxable income after tax year 2020. So in tax year 2021, you will be able to take any of those pre-2018 NOLs and still apply 100% of them to taxable income. Any NOLs generated from 2018 to 2020, after tax year 2020, it goes back to the old rule under TCJA, and you're limited to 80% of taxable income. And then any post-2020 NOL, you're limited to that TCJA 80% of taxable income limitation. Disadvantages and advantages of carrying back NOLs. So the advantages right now, it makes no alteration to the rate structure, which means you can generate a net operating loss in a year that has a 21% tax rate and carry it back to a year that has a 35% tax rate with no adjustments. If you have losses in 18 and 19, this can be advantageous as it could provide you cash flow. You can request a quick advance of the money owed from the carrybacks from the IRS. The downside to that is 2018 and 2019 were pretty good years for the market. So if you do not have a net operating loss in those years, it's not able to provide you cash flow. It'll help with your 2020 tax return if you have a net operating loss, but unfortunately it can't provide you any relief now. The other disadvantage is a lot of NOLs interact with a lot of other tax provisions that could negatively affect your carryback, essentially making the net benefit of doing this carryback not beneficial, or it could make your tax position worse. Some of the things to consider in those situations are corporate AMT, consolidated group returns. It also, by carrying back and opening up a closed tax year, it does give the IRS a second chance to audit or adjust your tax return. So if you had a challengeable item in that year, it may not make sense, or a significantly challengeable item in that year, it may not make sense to do the carryback. And there also can be some contractual and international issues as well. So essentially with those NOLs, it's a very good idea to contact your tax professional or run projections of what might happen with your tax return prior to actually doing the amended return to carry back that NOL, just to make sure that the benefit is really worth doing that. Also under the CARES Act, they made a technical correction that happened as part of the TCJA. And this allows taxpayers to claim 100% of bonus depreciation on qualified improvement property. And what happened is, prior to TCJA, qualified improvement property was depreciated over 39 years unless it's separately qualified as 15-year qualified improvement property, or the 15-year retail improvement property, or the 15-year restaurant improvement property. As part of the Tax Cuts and Jobs Act, Congress wanted to eliminate those 3 classes of 15-year property and just make it all one 15-year property. But the problem is when they did that, it didn't work out the way that they had expected it. When they made that change on TCJA, they made the qualified improvement property depreciable over 39 years, which made this type of property ineligible for bonus depreciation. So bonus depreciation would allow you to take 100% of that expense now. So what happened is the CARES Act corrected that. So now property acquired and placed in service after September 27th, 2017 is eligible for the technical correction. So it's essentially going back to the date of TCJA and fixing the problem, and any property after that is now eligible for this bonus depreciation. Anything placed into service in 2019, you can just take the bonus depreciation on your 2019. If you had additions between September 15th, 2017 and January 1st, 2019, you may want to consider amending your tax return to treat those assets as eligible for bonus. Part of the problem is we're still awaiting some procedural guidance on how we can go back and do that. There are forms that we can fill out, but we have to state what kind of adjustment it is. And we believe that it's going to be an automatic adjustment, but we still need the IRS to sort of come out and say that. If you have a business that has many partners or owners, it may not be practical to amend those returns. So there are some interesting nuances that you'll want to think about or talk to your tax professional about prior to amending anything and taking advantage of bonus. And then quickly, I just wanted to touch on some individual provisions under the CARES Act. So for individuals, some of the really nice provisions that came out were the stimulus checks that are starting to go out. Then there was also retirement account relief. So RMDs, or required minimum distributions, for 2020 have been waived, and you're not required to take those funds out of your investment accounts, which with the market seeing a decline early with this pandemic, that can be helpful to just let those assets sit and bounce back from that. So the RMDs are waived for 2020. The limits on loans that you can take from the accounts have increased from $50,000 to $100,000, and the 10% penalty for early withdrawal has been waived. The caveat with these two items is that you have to show / provide documentation of economic hardship due to the coronavirus. And I believe you may have to show that you were diagnosed with the virus. So these two provisions, the limit on the loan and the 10% early withdrawal penalty waiving, are nice provisions, but there are strict guidelines that you have to meet. So you would need to look into that further before being able to take those. Charitable contributions. So there now will be on your 2020 tax return a $300 above the line deduction for cash contributions, which means if you don't itemize your tax return and you have a standard deduction, you were able to take $300 of your cash contributions and take it off of your adjusted gross income before taxable income is calculated. If you are a taxpayer who itemizes, they have suspended the AGI limitation, which for 2020 would have been 60% limitation. And there were changes to the employer-sponsored educational assistance, and it was expanded to include qualified student loan payments. So I just want to touch base real quick on the stimulus check. They did start to direct deposit them a week or two ago. And they used your 2019 tax return. If you didn't have your 2019 tax return filed, they did go off of 2018 tax return information. It is $1,200 for a single filer, $2,400 for a couple, and for any child under the age of 17 claimed on your tax return, it's $500 for each child. There are phase-out limitations. If by chance you did not have direct deposit or direct debit on your 2019 or 2018 tax return, you can go to the IRS website, and there is an economics payment section, and you can actually search for your stimulus check payment, and they will tell you if it's being direct deposited, if it's going to be a paper check, and there is an opportunity to input your direct deposit information so that you can have that stimulus check sooner. One important note I wanted to make is that the state guidance, it does not always nicely follow the federal guidance. States can choose whether or not to decouple from the federal tax laws. We saw it in 2018 when New York State decoupled from the federal government with the TCJA changes. So they can pick and choose which provisions they want to decouple from. There has been no guidance from New York stating whether they'll decouple or if they'll follow federal guidance, but it's just something to sort of keep your eye on. So make sure you're checking your state websites and and checking in with your tax professional. They're going to be the best sources to find out how each state is handling these items. For more information, we are constantly updating our website, as Andrew talked about at the beginning of the webinar. So there's a link to our website for our CARES Act, which we update as often as we possibly can. The IRS website, specifically the Corona tax relief site, has a lot of good information. They're coming out with very easy to understand and very straightforward FAQs that have been extremely helpful. And the Chamber of Commerce has a COVID-19 business resource that is very good and can direct you to any site that you need. So now I will open it up for some questions.
Well, thank you, Michelle. We had a few come in throughout the webinar. I kind of held off on jumping in and asking them because I think some may or may not require some follow-up questions. So I'm going to go through and I'll read a couple out that came in, and I'll ask David to unmute the people who asked the question. So if they have any follow-up questions, they have that opportunity. The first one that I noted was from Larry Baum. Larry asks, on the PPP, are the state taxes that are part of the forgiveness calculation employee taxes withheld, or other state taxes paid, such as state income tax payments?
So so they've provided a lot of guidance. Unfortunately, some of it is not always clear. So what we have gotten from the guidance is that essentially what they're allowing you to take in this section is the New York State unemployment taxes. So they specifically state that you cannot include state employee withholdings, or you cannot include the state employee withholdings. Those do have to be remitted and cannot be reimbursed by PPP. Essentially, the only tax that we have been able to see is that unemployment tax from New York.
Perfect, thank you. Just exactly what I was looking for.
Nice.
Thanks, Larry.
The other one I had written down here was from Robert Poprosky. He asked, so capital gains taxes paid on 2017 tax returns could be offset by 2019-2020 NOL losses?
If it is a corporate tax return, yes. The NOL carrybacks, we are not 100% certain that they apply to individual tax returns with Schedule E and Schedule C losses. There are other provisions for Schedule E and Schedule C losses that allow you to essentially use any NOLs you have without having to carry back the return. So if it's a capital gain on a corporate return, then yes, you could carry them back. But if it's an individual return, you wouldn't be able to.
I had one more from earlier. Jennifer Demarest asked, just to confirm, none of these taxes are eligible to be paid through the PPP if we receive those funds. Jennifer, can you elaborate on that a little more? Just kind of rephrase it.
I believe Michelle already answered the question. Okay. That was, as she was speaking, I thought just a confirmation on what I was hearing, but I believe okay. I've gotten that question answered. Thank you.
Yes, thank you. I was hoping that would happen. It's kind of why I delayed some of these. We did just have one come in from Todd Mallinson. He asked, is it just commercial loan interest, or is residential mortgage interest able to be calculated in the forgivable amount of the PPP loan?
Currently, under what they have provided us with guidance, residential mortgage interest would not be applicable. The only place we've seen that it could potentially be applicable is if you are a sole proprietor and you are filing a Schedule C with a business use of home form. They could potentially allow that because it shows up on your Schedule C and can be verified. The only problem is again, we still have not had that final guidance from the SBA, and we're not sure if this is one of the areas that they're going to sort of delve into. But in terms of if it's for example, if you have multiple real estate entities in a partnership, you're not going to be able to take those, if any of those are residential rentals, you're not going to be able to take that interest against PPP. But again, the important piece with the PPP is that you really do not want to exceed that 25% of non-payroll costs, because that will kick you out and not allow that loan to be forgivable.
Does that take care of your question, Todd?
I couldn't unmute Todd, so I think he may just.
Yes, it does. Thank you very much.
Okay,
great.
Perfect.
We just had one come in from John Morris. He just asked if you could show the screen before the subject of NOLs started. So if you could jump back there, Michelle. And he also had a question that he typed in. He said, we pay all of the health insurance premiums for a 21% owner and a 12% owner. We also pay a portion of the health insurance premiums for a 2% and 1% owner. Can we use PPP to pay the health insurance premiums for all 4 of these employees? He says all of these owners are full-time employees.
So we just had a discussion on this today. The CARES team did, because the original guidance that came out made it seem like you could include salary compensation on the loan amount for a partner in a partnership or owner up to that $100,000. And then on top of that, you would be entitled to take health insurance and retirement benefits. The guidance that came out on the 24th that shows how to calculate your maximum loan amount by business type sort of shot that out the window. It essentially said, for example, with a partnership, if your self-employment income in total, which would have included their compensation, their health insurance, that in total could not exceed the $100,000. So the question with the owners would be, John, is it a partnership or is it an S Corp?
It says it's an S Corp.
Okay. So I'm going to have to say I can get back to you. If you'll drop your email address in the chat or to my email directly, I can get back to you on this. We're under the impression that since an S Corp who has owners who have employees, they get a W-2, which would then make them employees, and that would make them eligible to take those specified deductions and have them be forgivable. But we're still trying to do a little bit of research on it and still sort of waiting for that guidance. So if you want to shoot me an email, I can do a little bit more. Yep, I see it.
Okay.
I can email you back as soon as we get a little bit more guidance on that.
Okay,
I apologize,
yeah,
I don't have an answer now.
Yeah, that'd be fine. Yep.
I just sent you Michelle's email there, John, privately. We did have, let's see here, another question came in from Robert Waprowski. If the loan is not forgivable because it doesn't meet the 25%, 75% threshold, does the loan just carry an interest rate of 3.75%?
So with the PPP, the loan for any amount that is not forgiven, the loan is a 2-year payback loan. So you have a 2-year window to pay it back. You have 6 months of payments deferred. So essentially it's going to be a 1.5 years of actual payments. And the interest rate on it would actually be 1%.
Does that take care of your question, Robert? Okay.
I think the only potential caveat I'll throw out there with that one is that there is, when the media started reporting on some larger companies who received funding from PPP, there was some backlash that very large organizations received quite a bit of money when these programs were meant for small businesses who really needed it. So the SBA and the Treasury started issuing some FAQs. And as they started issuing more of those, they seem to be a little bit more harsh in their language. So those certifications that you are certifying when you initial those spots on the application, they potentially can interpret some of those that if you took the loan and didn't use it for the specified purpose, that you didn't, in good faith, actually comply with those certifications. Will there be a reprimand or some sort of follow-up? I'm not sure. But essentially, they're really, the SBA and the Treasury in the last week are really pushing those FAQs on the certifications and really trying to get people applying for the PPP to really be those small businesses that need this loan and who are willing to keep their employees on to keep them off of unemployment. So I would just, I would follow the SBA's FAQs. And if you haven't yet gotten a chance to read those, I would go to the SBA's website and you head to the COVID section or the Treasury website. And same thing, they have a COVID section that will have this document there. So just make sure you're reading those certifications and following to the best of your ability the guidelines. And I think it's going to depend on your bank as well with the forgiveness. So it may depend.
Okay. We just had another question come in from Romy Fain. If employers are unable to spend 75% of the initial loan on salaries during the 8-week time period, for example, employees electing to stay on unemployment, will the salaries paid still be forgiven?
So that's the big piece that we're waiting on with the guidance. We don't know, and there is no guidance even essentially mentioning what happens if you don't spend if you don't spend the entire loan proceeds in that 8 weeks. What happens? Do they have to be paid back? Does that roll over into a loan? And if you use the loan proceeds for payroll, will it be okay? So that's essentially the hard part we're having with this question, is that they really have not said what's going on. The other issue this brings up is the constant battle right now between unemployment and returning to work. So with the pandemic unemployment assistance, there is a whole list of reasons why you can receive unemployment due to COVID-19. So it's been murkying the waters a little bit. If your employees were entitled to and are receiving straight New York unemployment insurance, even if they get that extra $600, if it's under New York unemployment insurance, if you call them back to work and they do not return because the benefits are better on unemployment, there actually is a whole bigger issue of unemployment fraud, because the certifications they have to make each week that they are ready, willing, and able to work are obviously not true. So there's some bigger unemployment issues with this as well. So we're really trying to see what's going to happen with the guidance, because especially in this area, we have a lot of restaurants, and some of those employees are making more on unemployment than they do working. So restaurants that receive these PPP funds want to call their employees back and pay them and use the funds for what they're intended, but they can't get them to come back. So we don't know, if you can show that you tried to call them back and that you are, if you only use if you pay for all the payroll costs that you can in that 8-week period, and you still have money left over, potentially if the money left over, if you take that out of consideration and 75% of what you spent was payroll, they may require you to pay back that amount not spent, but then still forgive the PPP loan. And I wish I had a better answer, but we're still just sort of waiting on this piece. And this is the big one that we're sort of waiting on and just trying to get some sort of clarification or guidance from the SBA. I apologize, I don't have a better answer.
Any follow-up there, Romy, or are you all set?
No, that's great. Thank you. Can you hear me?
Yes.
Yep.
Okay, great. I thought I had the wrong headsets on. No, that's great. Thanks for giving it a shot. I realize this is a moving target for everybody. So yeah, just when you guys find out something, maybe send it out to us.
Absolutely.
Yeah, the best way to stay in touch with us will be through social media, where we're going to be pumping out blogs on our website, and anything that goes out there will go out on social media as well. So we're on Facebook, Twitter, and LinkedIn. So give us a follow there, and we'll be sending out any new guidance that comes out as soon as we're able.
Okay.
And if you happen to be a client of Sciarabba Walker's, we are doing email blasts. So as long as we have your email, as new stuff comes out, we are, sending email blasts out to our customers. So if you are a client and don't have an email address on file with us, let us know, and we'll get that fixed.
No, I am getting your emails. That works great. Thank you.
No problem.
Do you have any other questions out there? I haven't seen any come in, so I think we're probably all set here.
Awesome. Well, again, I just want to say this is a lot of information to take in. Michelle, if people wanted to have access to the PowerPoint you presented today, would they be able to email you and reach out, or would you guys be able to have this available on the website?
Absolutely.
Work on getting it up on the website once you get me that link, David.
Mm-hmm.
I'll say if people have additional questions, I'll drop our generic email address into the chat here. That's info@swcllp.com. We'll be monitoring that, and any questions that come in, we can make sure that those get to the right department as well. But yeah, we'll work on getting this up on our website as soon as possible.
Awesome.
David, if I send you the PowerPoint, does the chamber have the ability to email it directly to the attendees?
Yeah, we can do that.
Okay, so I can send this over to you as soon as we're done.
People can reach out to me direct. My email is all over the place. It's David. It's dwalton@tompkinschamber.org. I'll put that in the comment section as well. And we'll also try to make these available via the website. The video link will go out today as well on the Chamber's YouTube page. So stay tuned for that. And again, I know that you guys will make yourselves available for anyone if they have any follow-up questions through Sciarabba Walker Direct.
Absolutely.
Awesome. So to everyone who joined us today, thank you so much for being here. Andrew, always a pleasure to see you, man. Michelle, thank you for your information. You were amazing. And again, just stay tuned. The Chamber is here to be at your disposal. In the community, we're all in this together, and we will get through this. All right. So you guys enjoy the rest of your, what's today? Tuesday? Wednesday. Oh my gosh. Enjoy the rest of your Wednesday, and we will be in touch soon. Stay healthy, stay safe.
Thanks, everyone.